In this video we are going to talk about 15 great dividend stocks. So before starting this video, please like this video and subscribe to this channel for our future updates. Number 15. Target Corp, ticker, TGT. Target is the first option on the list, and it's also one of the least profitable. Currently, shares pay only 1.4% in dividends. However, there are two considerations to consider. To begin with, Target still yields slightly higher than the S&P 500 as a whole. The second reason is that Target's dividend has fallen in part as the stock price has risen dramatically over the past year. That isn't a bad issue to have. The company's success stems from a $7 billion digital push that began in 2017 in an effort to make it more competitive in an increasingly e-commerce environment. Target matched customers' pandemic demands, and that investment paid off handsomely in 2020 as shoppers sought out companies that could manage online groceries and basic items. Target has milked that momentum for all it's worth in 2021, turning up stellar quarterly earnings results after quarter. Number 14. Greif Inc. Jeff. Greif is the smallest firm on this list, yet it is a force to be reckoned with. In 2021, the packaging materials and containers manufacturer is in the right place at the right time. The increase in consumer demand has resulted in a surge in the need for boxes and other packaging materials. Greif's revenue increased by 38% last quarter compared to the same period in 2020. Earnings were also far higher than expected. There have been certain pressures as input costs, such as wood pulp, have risen. Greif, on the other hand, has been able to mitigate those worries by raising pricing. To cut a long tale short, Greif is set to profit as American consumers shop like never before. It also distributes profits to its shareholders. Jeff's stock presently yields 2.6%. Number 13. AbbVie Inc. AbbVie is a returner to the list of the greatest dividend stocks, having made the cut in both 2019 and 2020. It's easy to understand why. AbbVie distinguishes out as a one-of-a-kind dividend stock in a market devoid of them. It's one of the healthcare industry's best-paying stocks. AbbVie is unique in that Humira is the company's primary source of sales and profit. That medicine is, without a doubt, the most popular pharmaceutical product in recent years. Bears will refer to Humira's potential downside risk once the drug's patent expires in a few years. However, the company has broadened its horizons by acquiring the rights to other medications like Botox. Right now, shares yield 4.8%, and given that the stock isn't expected to rise much in 2021, this could be a good time to buy. Number 12. J.P. Morgan Chase & Company, JPM. Banks return. After the 2008 housing market collapse, many investors vowed never to hold a financial stock again. Many individuals were unaware that regulators had tightened bank regulations, making the system safer. During the pandemic, investors feared huge loan losses. Instead, the banks sailed right through. Now, everything is put up for the banks. It's a boom time. The market is ablaze. The Fed will start tapering and interest rates will likely rise in the next years. JP Morgan is one of the best-run large banks, making it a safe choice for investors. The bank's 2.4% return may not be eye-catching, but the firm's business quality more than makes up for it. Number 11. Johnson & Johnson, J&J. J&J is a blue-chip stock. Every year, the company's revenue and profitability grow a little. As a result of this constant growth, it increases its dividend every year. Achieving 58 years of dividend growth makes it one of the few American dividend kings, or stocks that have increased payout for at least 50 years. Under one roof, J&J's healthcare company is vastly varied. Also, the consumer business sells everything from Listerine to Pepcid and Band-Aids. The company sells pharmaceutical medications and medical gadgets. Due to the pandemic, hospitals postponed elective surgeries in 2020. In 2021, the company is back on track, so now is an excellent time to pick up its 2.6% dividend yield. Number 10. Iron Mountain Inc., IRM. Iron Mountain is a document and data storage and security REIT. Investors believe that a drop in paper document usage would harm the business. A greater digital focus on data backups and data center operations has allowed management to adapt. In any way, Iron Mountain shares have rebounded to new highs in 2021. Meanwhile, the corporation pays a 5.2% dividend yield. That's partly attributable to REITs. Due to their legal structure, REITs are exempt from double taxes on income, but must distribute at least 90% of profits to shareholders. That was a good deal for Iron Mountain shareholders. Number 9. PepsiCo Inc. (PEP). Most people think of Coca-Cola when they think of food and beverage stocks, KO. But PepsiCo is more timely. In 2020, people stopped coming to movies, athletic events, restaurants, and other places that sell soft drinks in big numbers. PepsiCo had a stronger year thanks to its Frito-Lay snack food division. During the difficult quarantine period, junk food intake did not slow. PepsiCo began 2021 with analysts worried about inflation. Because PepsiCo has strong brands, it can boost prices to offset low input costs. PepsiCo recently hit new 52-week highs. In a frothy market, investors are turning to safe, fairly priced blue-chip stocks. Number 8. Discover Financial Services, DFS. Discover is one among the highest-yielding credit card issuers on the list. MasterCard Inc. (MA) gives a 0.5% dividend yield, barely over the typical bank savings account. Discover shares yield 1.7%. Thus, Discover has a 20% payout ratio to earnings, allowing them to raise the dividend in the future. This is a great opportunity to learn about credit cards. During the epidemic, the Fed and the government provided enormous economic support. Consumers are ready to spend. Consumption of appliances, home goods, travel, and experiences grew in 2021 as people began to enjoy the better things. Discover and its contemporaries have seen increased profitability. Only 8.8 times projected earnings for Discover. Number 7. Cisco Systems Inc., CSCO. Cisco pays 2.6% today, making it one of the highest-yielding tech equities. That's partly because Cisco is now a tech utility. Cisco's routers and networking hardware are vital to the internet. But most of the technology is already established. Like many other giants, Cisco doesn't have to invest tens of billions of dollars in developing the metaverse or self-driving cars. Cisco may thus offer a significant capital return scheme to its stockholders. Cisco isn't the most exciting tech stock. But at around 16 times forward earnings, it can be a solid steady addition to a broader growth and income portfolio. Number 6. Mondelez International Inc., MDLZ. Not all food and beverage stocks made the list. Also, Mondelez makes Oreo, Cadbury, Toblerone, Halls, Trident, and Tang. People filled up their pantries during the pandemic, boosting sales in 2020. In 2021, that stimulus has dissipated and cost inflation pressures have increased. However, a food giant like Mondelez will be able to force through price rises and emerge stronger than ever. The shares are risen marginally year-on-year, making this a bargain. Meanwhile, the company pays a 2.3% dividend. Number 5. Crown Castle International Corp., CCI. Another REIT on the list is Crown Castle. The corporation owns, operates, or leases 40,000 cell phone towers, mostly in the US. It also manages tens of thousands of miles of fiber optic cable. This puts Crown Castle ahead of many of its REIT contemporaries. REITs linked to malls, shopping centers, or offices have struggled in recent years. But cell towers have a bright future. Nowadays, everyone uses mobile data. The Internet of Things and 5G will amplify the trend. Number 4. AT&T Inc. AT&T has been the worst dividend stock disappointment in 2021. Its streaming business seemed promising. However, management failed to deliver and ultimately decided to spin off that business with Media Peer Discovery Inc. (DISCA). The AT&T dividend will be drastically reduced due to corporate restructuring. While the corporation will still give a high yield, it will be less than the previous 8%. The negative news is already priced in. AT&T's stock has plummeted, and the company's management is focusing on core telephony. Number 3. Antero Midstream Corp. AM. Antero Midstream is one of the list's riskier companies. It's a subsidiary of Antero Resources Corp., which produces natural gas in Pennsylvania, Ohio, and West Virginia. Antero Midstream manages natural gas gathering and compression, processing, water delivery, and blending for its parent firm. Antero Midstream still yields over 8% in 2021. A high yield normally indicates a possible cut. But with natural gas costs skyrocketing, that seems improbable right now. Number 2. Newmont Corp. NEM. Newmont is a major gold and metals miner in North America. The quick economic recovery and massive government support seemed ideal for gold miners. Rather than gold, it appears that much of that demand moved towards cryptocurrency. For some investors, Bitcoin appears to be a good inflation hedge, an alternative to fiat currency. Number 1. Kimberly-Clark Corp. KMB. Kimberly-Clark rounds off the list. It is well known for its toilet paper, but it also provides soaps, cleaning supplies, diapers, and incontinence items. So far, the corporation has had a quiet 2021. Due to pandemic-induced worry, many people bought more paper items than necessary last year, hurting sales. Input costs are rising due to current inflation. Regardless, the company's prospects seem bright. A year of virtually unchanged shares makes them a bargain compared to the market. Kimberly 3.4 Clarks% dividend yield also appeals to income investors. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.